Mic check. Is this thing working? I think it is. Happy Monday, folks. April 7th, 2025. First Move Focus. Pre-market musings here. Game plan hasn't changed, at least inside of TTI. We are waiting for some sort of sustainable bounce, but I do think that action overnight, futures opened up, really caused a ruckus over on Twitter and YouTube and people freaking out. Obviously, that's totally okay. I understand where we're coming from that. But I want to stress that in the middle of chaos comes a lot of opportunity, both from a day trading perspective or an intraday perspective, short-term perspective, but also from a longer-term perspective. For those folks that were trading through the COVID drop, meaning you did not start during the lockdown period, where a lot of people that we're talking with every single day started during lockdown. They've never experienced something like this before. So just understand that the behavior is going to be a lot more erratic if you've never dealt with anything like this before. But for those of you that were trading through COVID, potentially through the 2018 drop down, Q4 of 2018, you've been through potentially the GFC, these chaotic environments bring in a lot of opportunity to the long side over the longer term. And I'm not talking about just strictly long-term portfolios, but from a tactical standpoint, 45 to 180 days out, when there is a substantial bottom formed, if you're unable to pull the trigger, you're going to miss out on an incredible opportunity that can potentially make you a bunch of money. It's just that simple. So something that we're looking at inside of TTI, we're not necessarily buying anything yet, but we do think we're closer to the end than not, at least in terms of pure TA. That doesn't mean that the market can't mull around down here and continue to trend sideways or whatever, but we do think that the end is closer than the beginning here after this massive 25% move in the Qs. I want to point out here that we are testing those 2021 highs, and from a pure technical standpoint, think about from a secular breakout standpoint, generally speaking, markets do pull back and retest those breakout points. You have overnight here the NASDAQ futures retesting that 16,600 area, which is essentially your 2021 highs. And then if we look over at the S&P here, E-mini, coming down and testing the 4,800 area. So I don't think that this is a coincidence that we find some sort of bounce here. Is this enough to usher in new buys? I don't think so. I think we need some supporting evidence here, but I would start looking at potential opportunities, at least in the short term from a tactical standpoint, at these levels. These are washout levels. You saw the move overnight. We're just getting information in on markets around the world. Some of them are having the worst day that they've had in the last 20 or 30 years. The United States right now kind of shielded from that a little bit. We've bounced back up a lot pre-market here. We were down at one point. There were threats of a circuit breaker near the market open. As of right now, that doesn't appear to be a risk, at least not yet. We're down only about, actually, we've come back a lot. I'm very surprised we're down about less than 2% now. And at one point we were down, I believe, 5%. So a big bounce here overnight and into pre-market. Seems like the rest of the world is taking it on the chin right now, whereas the United States is chilling right now. But that could change very quickly at market open. I have no idea. And once again, we're looking at taking some shorter term day trades or scalps in here to take advantage of the volatility. From a longer term perspective, we're looking for these levels to hold. 478 in the S&P 500. We're looking for the 405 area to hold in the NASDAQ, building out some sort of floor here, or a V-shaped recovery is totally in the cards. And if that happens, you have to have a process to get you back into the best stocks when or if you get the confirmation that you need. I think it's important not to hold any biases coming into this type of stuff from a technical standpoint, fundamental standpoint, vibes standpoint. Everybody's going to have an opinion and a bias on what tariffs are going to do in the markets. And all I'm going to say is that these types of crazy moves tend to exasperate themselves and go a lot further than most people expect. We're looking at levels to meaningfully hold based off of secular breakouts, but if they don't hold, I'm not going to lose any money trying to just throw capital at something that the market invalidates immediately. My bias and my opinion has absolutely nothing to do with this. I'm strictly looking at areas of confluence where you can reasonably assume that there might be some sort of support there, some sort of bounce, institution stepping in, buying it off of those levels. That's what I'm looking for today, these levels to hold. I'm open to either a V-shaped recovery like we had back in 2020. And the only reason why I'm talking about a V-shaped recovery is because the rate of descent, on the way down is just so extreme, right? We're down 25% in the NASDAQ in like a month and a half. That's extreme. There's going to be some sort of very, very, very nasty whipsaw back to the upside. It's going to wipe out overzealous shorts, people that are going short late. Whether or not that short turns into a bigger uptrend, I have no idea. But there will be a very, very nasty rally to the upside that squeezes the shorts. And it's going to go a lot further than most people expect. And it's going to sucker in a lot of bulls. And if it's not the reversal that people are expecting, that's going to be more ammunition for bears to continue to have those longs capitulate into lower price points. So once again, it's a challenging environment, right? But if this was easy, everybody would be able to do it and there'd be no way to make any money. So I'm happy that it's challenging. We're looking for the 478 level to hold in the S&P 500. Once again, for the Qs, we're looking for the 405 area. And one other thing I want to bring up really quick is if we do get some sort of bounce here and we don't have higher beta areas of the market leading, I'm talking tech, right, your XLK, if this isn't finding some sort of support at the 177 area, so this is where you would expect from a technical standpoint to find support, previous cycle highs, very important. If we're not getting a bounce in consumer discretionary, right, we're no man's land right now in consumer discretionary and communications, which is held up on a relative basis better than all three of them, retesting our previous cycle highs. You can see how many times this theme has came up, coming back and retesting those previous cycle highs. This is an important area on the chart for many different tickers, tech, communications, comms, the S&P 500, etc. We want higher beta areas to lead. If we get some sort of meaningful bounce and you don't see tech, consumer discretionary, or communications taking a leadership role, I would be very, very hesitant to throw large amounts of capital into the market to the long side because reasonably speaking, these are the areas that tend to lead off of the floor. If you think about the types of stocks that led off of the 2022 bear market low, home builders and semiconductors, those are two very offensively positioned cyclical industry groups. And if those aren't the types of stocks that are moving the fastest or first, might be yellow flag, might not be time to go ahead and buy the dip with any sort of serious size. What we don't want to see are names like consumer staples. I don't give a shit if Coca-Cola rallies. I don't give a shit if Pepsi rallies. That doesn't excite me from a technical standpoint. We need to see high beta areas moving off of the floor. If we see utilities lead, might not be the right time to go and open up a bunch of new high beta software stocks at the bottom, or what we think is the bottom. If we see things like energy lead, which right now energy is getting absolutely destroyed after just sitting up near 50-day highs for a couple of sessions, also not the type of stock that we want to see leading in an actual market bottom. So this higher beta relationship is very important. We can look at that and visualize it from a different standpoint as well. We can take the higher beta ETF versus a lower volatility ETF. Generally speaking, in a strong bull market, this ratio is moving up and to the right. As of right now, we can move this circle over. We are at 24-month lows. Looks like there's a minor bounce here pre-market. But unless this higher beta ratio against lower volatility starts to uptrend again, I would be very, very cautious about buying large quantities of stuff, at least inside of TTI, right? We're not focused on owning Coca-Cola and Pepsi. We don't give a shit about that stuff. We don't want to trade it over the next 180 days. We're going to use that as a puzzle piece, right? If those are the areas of the market that are leading, we don't want anything to do to the long side yet, right? And let's talk bonds. Bonds have an interesting role in this entire market sell-off. They have not sold off yet. Is there an opportunity for the market to sell this off or rally this? I think around the 200-day moving average is an important area to be looking at. Obviously, we all know that the goal of this tariff war, if you will, is to bring down the interest rates, force the Fed to move. And as of right now, interest rates have been coming down. So is this a potential play above the 200-day moving average? I think you could probably throw a couple bucks at this. I did last week. Above the 200-day moving average, I like this on a short-term tactical basis up to the 100 area, but I'm not entirely sure that bonds are going to be breaking out on a new cyclical basis after basing over the last couple of years. I don't think it's in the cards yet, but if you're looking for an inversely correlated asset, at least over the last couple of months, to stocks, bonds have been going up while stocks have been getting crushed and yields are coming down. And there's a shorter term tactical play up to the 100 area, I believe. We break above 100, next price target up is 110, but that's so far away, it's not even worth talking about right now. The dollar continues to get sold off here. We're looking at a potential secular bounce somewhere near the 102, 101 area. Do we actually get that? This has been inversely correlated to stocks over the last couple of years, but since the Trump election, the dollar and stocks have been positively correlated, meaning dollar crushed, stocks crushed. As of right now, the dollar is down again, but we are finding support at a previous level of contention. Will that be good for stocks, bad for stocks? We have no idea right now. Correlations have completely decoupled, right? We were trading through an inversely correlated environment, which really was hard for a lot of people for about 2.5 years. The dollar down, stocks went up, dollar went down, etc. Well, now we find ourselves in an environment where the dollar and stocks are tracking in the same direction. So it's incredibly challenging to rely on any of these correlations right now, which is why I think, kind of going back to some of the more primal instincts in the market, below the 200-day moving average is not a place to be opening up large amounts of exposure, right? I'm going to tell you right now, there's going to be an incredible amount of opportunity coming up very shortly in the market from a long-term perspective, if not already here, depending on what you're looking at. But general rule is don't buy with size below the 200-day moving average. I mean, it saved our ass inside of TTI. We've been more or less risk off for the last couple of weeks. We haven't been buying any of the Mag 7 stocks that are breaking down. We haven't been buying any of the high beta stuff that's been breaking down with any sort of size. Below the 200-day moving average is a very difficult way to make a living as a trader if you're looking to long this market. Bullish biases will get crushed in downtrends just as much as bearish biases will get crushed in uptrends. It's how this stuff works. The last thing I'm going to leave you with here is that Mag 7 conversation. Mag 7 continues to get sold off. It's mathematically impossible for the major indexes to catch any sort of relative uptrend with momentum if the Mag 7 stocks are not contributing. It's just a pure math standpoint, from a weighting standpoint. Mag 7 holds so much of the sway of the major market averages. The S&P 500, the NASDAQ. The S&P 500 is 30% tech. NASDAQ is 50% tech. Now, tech is one of the worst, if not the worst performing sector of the last year, or this year, excuse me. But realistically, it could be over the last year because it peaked back in June or July of last year. Mag 7 not going up is going to be a detriment to the indexes. So what I would look for, you don't need to necessarily go and buy the Mag 7 stuff yet. But what I would look for is some sort of bounce in the Mag 7 stocks that lines up with a lot of the different things we were talking about. Levels being tested in the Qs, the S&P, the tech sector, the communication sector. If we get some sort of meaningful bounce in the Mag 7, we get some sort of momentum thrust, potentially we have some sort of bullish divergence right now in the RSI. Do we want to play that? Not yet. That's just supporting evidence. I would be looking for Mag 7 to bounce and find a floor and lead the indexes higher. If the indexes bounce and the Mag 7 doesn't bounce, I would be very cautious about looking to go long with any sort of size. So that's the game plan for today. If you're day trading or scalping, days like today, Friday, Thursday, these are your Super Bowls. You need gas in the car to be able to trade intraday. There's a lot of gas right now in the market. So set your levels, have a game plan, hopefully make a bunch of money on both directions if you're day trading this. If you're swing trading, we're going to continue to sit back and we're going to wait for more favorable setups. But we'll see. We're testing some levels right now that are important to us. We'll see how we react later today. Okay, if you're inside of TTI, I'll talk to you in about 5 minutes over on Discord. If you're not, I would love a like, a comment. Do you think that we're somewhere close to a bottom? Do you think this thing continues to go down? Is this the next .com bubble blow up? Is this worse than that? You tell me. I've seen a lot of crazy stats over the weekend. And for those people that like to say, well, this time is different, this time is different. We are setting new records. So congratulations, you're a part of history, regardless of whether or not you're a bull or a bear. Okay, enjoy the rest of your Monday, folks. Stay safe, and I'll see you tomorrow morning for the next first move focus.